Silver is the most explosive market I can think of right now in terms of upside potential. I think when a market has been overdone, either upside for too long and too high, and it collapsed, the stock market starts now to break. The bond market's highly in question. Where are you going to go? It could be a wet bar of soap phenomenon for the miners and for silver versus gold. $750 off the bear low and about another $900 to go on the upside. Gold decided to have a corrective pullback. It happened to coincide with a puke month in the S&P. At that point, the next month, Bernanke came out, panicked as hell, and took a page out of the Japanese playbook and instituted QE. I mean, I guess it didn't get the message. You're supposed to go down with the stock market, okay? You get the point. Gold is an alternative asset category. When the house catches fire, all the money doesn't get burned up. The money flees. So if gold merely matched the prior bull markets, would be 8,000 to 9,000. Merely matching those bull markets. With these conditions out there, it wouldn't shock me to see gold at 10, 20,000. Silver is the most explosive market I can think of right now in terms of upside potential. And we've been arguing this for a couple years. Silver's value to gold is off the page, low. Silver was stuck in a price range for 50 years with two highs at $50. In 1980, when silver was 50, gold was 850, okay? Gold right now is where? 4,600, let's say, versus 850. And yet silver's only trading $16. No, excuse me, it's about the 70, so $20 above its 1980 high. That's trivial. Look at copper, steel, lead, zinc charts going back to the 1980s. Most metals made highs around that time. They're trading at 4 times to 6 times where they were that number decades ago. How come silver's only trading a small percent above its 1980 high? Gold's 4.5 times, et cetera, et cetera. Silver made a mistake. Now, maybe it was arbitrarily done by intervention, manipulation. I think that's probably true. But that didn't work because silver broke those restraints late last year when it blew through 50. So it said no more. And I think if silver merely catches up to lead, zinc, steel, aluminum, gold, and they stood still, those markets stayed where they are now, silver could go up to $500 or so. It wouldn't shock me. And also, if you look at the money supply, M2, and you go back to 1980 and see where M2 is now, how much more money has been printed, factor that into the price of silver versus 1980, you come up with something like $500.
Silver's biggest risk may be that investors finally discover how far behind it has fallen. As Michael Oliver notes, silver could approach $500 simply by catching up with other major metals and adjusting for decades of monetary expansion. That doesn't make $500 inevitable, but the valuation gap is difficult to dismiss when gold has already multiplied several times since 1980. For investors, the danger isn't just missing upside, it's assuming today's price still reflects silver's historical value. Next, Michael Oliver exposes why suppressed markets can overshoot their fair value.
That's a to-be-expected norm, in my view. It's not my target. I frankly think when a market has been overdone, either upside for too long and too high, and it collapses, like, let's say, .com did, 80% drop then, like 2000 to 2002 in .com. And yet .com was a true statement. It really did change our lives, and yet they collapsed 82%. Silver has been oppressed for 5 decades, okay? 50 years. 46, actually, okay. But if it's been an error, quite often when markets make errors, they overdo it in correction. In other words, if they're too low for too long, they don't just go to what might have been a norm. They overshoot it in an emotional burst, especially when you've got the situation now where there's no other alternatives. If the stock market starts now to break, the bond market's highly in question, where are you going to go? You get the point. It could be a wet bar of soap phenomenon for the miners and for silver versus gold.
Is this a trend that we should be worried for? Of course, a capital rotation can be very beneficial to the sector, but if too much of it occurs, you might see a liquidity crunch instead that draws down everything at the same time. Is that what we're talking about here, a market-wide liquidity crunch downwards that could pull gold down with it as well?
The real danger isn't silver rising too far. It's investors being positioned for a normal correction when the market becomes emotionally explosive. According to Michael Oliver, markets that remain undervalued for decades can overshoot violently once capital finally rotates toward them. That matters because a stock or bond shock could redirect money into a tiny mining sector, creating extreme moves rather than orderly gains. For wealth holders, timing the rotation may matter more than predicting a precise price. Next, Michael Oliver reveals why a liquidity shock may not affect every asset equally.
I don't buy that argument because, not that you're making it, but it is a very popular conception. It's based on a few random examples in history where gold went down at the same time as the stock market. Let's take the one that's conspicuous in everybody's mind, October 2008. Okay. If you look at gold long-term by our metrics, it made a major bear low in 2001 and 2 at a price of about 260. Okay. It had been 850 in 1980, and it pulled all the way back down to there, made a long base, 2001 and 2, and then made a 10-year bull market that took it up to 1920, an eightfold move. But in the middle of that move, at $1,000, $750 off the bear low and about another 900 to go on the upside, gold decided to have a corrective pullback. It happened to coincide with a puke month in the S&P. Now think about this. The S&P topped in October 2007. Gold was already going up at that time. And the S&P would drop for a full year, and it wasn't until October 2008 that finally the S&P had what you could call a crash month. It had a 30+% drop in 1 month. At that month, gold said, I think I'll have a correction too. It hadn't had one in a while. And it had a very rapid, very bad month that took us from over 1,000 down into the 600s. At that point, the next month, Bernanke came out, panicked as hell, and took a page out of the Japanese playbook and instituted QE.
The 2008 crash created a dangerous myth that gold automatically collapses when stocks do. What Michael Oliver is highlighting is that gold had already been in a major bull market before that isolated 2008 correction, while equities had been falling for a year. The distinction matters because 1 month of forced liquidation can obscure an entirely different long-term trend. Investors who treat correlation as destiny may abandon protection precisely when monetary stress accelerates. Next, Michael Oliver unravels what happened immediately after that famous gold sell-off.
November 2008. Okay. Stock market kept going down until March 2009. So the QE didn't help the stock market at that point. In fact, there was a lot more to go. Gold reversed immediately and was back to the highs within months and on its way to 1900. And meanwhile, the S&P never got back to that 2007 high until I think it was 2013. Okay, for years. So there was 1 month in there, therefore, when gold did go down with the stock market. Everybody thinks, oh, well, see, that's what's going to always happen. Go back in history, 2000 to 2002, dot-com collapse. S&P went down 50%, NASDAQ 100 went down 82%. Gold rose during those 2 years and continued on up through 2008. Then there was the 2008 collapse, that 1 month, but then it continued on up. It was basically that collapse where the stock market was in the middle of a bear trend and gold had a 1 month drop, and everybody thinks, oh, see, therefore it follows stocks, okay? Well, how come if stocks just got whacked this week big time, pretty good whacking on this new news, the gold miners exploded? Nobody's commenting on that, okay? And you go back, way back in history, 2007 to 9, and as I said, the bear market stocks, gold rose during that period. Yes, it was a bad month. Go back to 1929 to 32. another massive bear market. Stock market went down 80% during that 2.5 years. You couldn't buy gold because it was illegal. They banned it, okay. But you could buy gold miners. Homestake mining in particular went up like 1,000%. Well, the stock market collapsed.
The strongest evidence against the gold crashes with stocks narrative is what happened after the crash itself. Michael Oliver's argument suggests that gold rebounded while equities remained trapped in a prolonged decline, exposing how one violent month can distort the bigger picture. The same pattern appeared across earlier bear markets, with miners sometimes exploding as stocks collapsed. For investors, that means diversification isn't merely about owning different tickers. It's about owning assets driven by different monetary forces. Next, Michael Oliver exposes why tiny mining markets can become escape valves.
I mean, I guess it didn't get the message. You're supposed to go down with the stock market, okay? You get the point. Gold is an alternative asset category. So when the house catches fire, all the money doesn't get burned up. The money flees. A lot of it flees, and it goes to alternative categories. But when you look at the gold miners and silver miners, they're vastly undervalued, but they're also tiny as an asset category. So it doesn't take much money fleeing the stock market to goose that wet bar of soap straight up, okay? So that's what I think we're beginning to see. Now, I'm not sure where I think gold is going to go. By the way, we can use that as a first metric, and therefore if gold's going up this amount, then maybe the miners will go up twice that amount, right? That's what that spread suggests. If you look at gold's history, the bull market peak in 1980, after a bear low in 1976 near 100, you went up to 850. It was an eightfold move. It took 3.5 years, okay. Then 2001 and 2, you had an eightfold move to 2011. Different duration, but also an eightfold bull market. We were only fourfold because our bear low was 1,050 in 2015. So we're only half as much up as the two prior bull markets on a percent basis. And yet we have these events that have been percolating on the sidelines and nobody's recognized. The government debt crisis globally. And suddenly, and the T-bonds, which used to compete with gold as an alternative, not being a place to be.
The overlooked variable isn't gold alone. It's how little capital the mining sector actually needs to move violently. This is where Michael Oliver's thesis shifts from metal prices to capital flows, because a relatively small rotation out of stocks can overwhelm a much smaller mining market. If gold continues rising while miners outperform, that divergence could become a warning that institutions are repricing monetary risk. For ordinary investors, ignoring that spread could mean entering after the easy money has already moved. Next, Michael Oliver exposes the historical upside implied by previous gold cycles.
So if gold merely matched the prior bull markets, it would be 8,000 and 9,000. Merely matching those bull markets. With these conditions out there, it wouldn't shock me to see gold at 10, 20,000. I don't have a prediction of where gold's going, except to say it's at least going to do a ho-hum replication of the prior two bull markets. Eightfold, okay. Now,
perhaps we can also talk about the catalyst of the breakout of the miners that you outlined earlier. Of course, we're awaiting this potential breakout from the miners against gold. What could potentially unleash the gold miners to really start rallying?
Yeah, I think they've got the fundamental reasons to rally. You know that, I know that. I mean, they're making tons of money. You know, if you took the name gold miners or silver miners off the name of the stock and just said stock A, B, C, and D, and then analysts went in and looked at the balance sheets and the earnings, and which change quarterly. You know, because look where we were now versus a couple of quarters ago or a year ago or 2 years ago. Jeez, the price has doubled, you know, on all the metals, if not more. So, you know, they're rampagingly making money, and yet nobody's acknowledged it until now. They're starting to. And I think the recent explosion, by the way, it was 2.5 weeks ago we said they were going to explode. We had a technical reason coming up off that last low in the miners and the gold. We had 1, 2, 3 lows since January, each low being marginally below the prior low. So like 1, 2, 3.
Gold doesn't need a miracle to reach extraordinary levels. It only needs to repeat a pattern already seen twice. Michael Oliver notes that previous major bull markets produced roughly eightfold gains, while the current cycle has so far delivered about half that percentage move. Meanwhile, miners are generating far stronger earnings as metal prices rise, yet investors have been slow to reprice them. That disconnect creates asymmetric opportunity, but also crowded risk potential once recognition becomes widespread. Next, Michael Oliver reveals the technical signal suggesting miners may already be leading.
Not very much below, but enough to make a new low 3 times in a row. We said after that third one, that's it. And as we came up off that low 3 weeks ago, actually, we triggered momentum numbers that said, okay, silver and gold gone. They're going to go back up. This time the rally won't be just another rally in the range. This time the rally will get up and blow out the highs, ultimately. Probably, I'm guessing, within a month or so. But I think that's begun. And this breakout by the miners versus gold is even more of a table-pounding warning or green light that this is about to happen. That spread's not going to break out for no reason.
That's incredible. I would love to also get your take on the platinum group elements. Is that a very similar story to gold and silver?
Not. They behave, if you go back and study platinum particularly, it's really a precious metal. So we don't use the term precious metals when we talk about gold and silver. We use the term monetary metals. Yes, silver does have industrial aspects to it. And we know that it's been 6 years of deficit supply to demand ratio, and yet it's been ignored by investors. But platinum, when you go back historically and overlay its price chart, let's say versus gold, or overlay it versus the Bloomberg Commodity Index, you'll see far greater correlation to the broad commodity complex. And after laying low, while gold's been exploding, since 2015, you look at platinum chart, and it only just woke up a couple months ago, where it said, boom, I'm out of here, okay? So it looks like it's trying to coattail gold, but really what it's reflecting is the upturn in broad commodities. And yes, we're positive on platinum, but we don't treat it as a monetary metal. And I prefer to be in monetary metals at this point because of the nature of the crisis we face is monetary.
3 successive marginal lows followed by a momentum reversal can matter more than another bullish headline. According to Michael Oliver, the miners versus gold breakout is a stronger confirmation because it suggests capital is beginning to favor miners rather than merely chasing metal prices. That matters alongside silver's persistent supply deficit and platinum's different commodity sensitivity. For investors, the key isn't treating every metal equally. It's identifying which market reflects monetary stress most directly.
You got to be watching the T-bonds. We told them, and sure enough now, we're starting to get that message, the average guy is. And we look at commodities, we look at stock markets, not just ours, and government debt markets, and foreign exchange. And that's a big issue too, because the dollar index right now is about to implode. Our momentum said March of 2025 that it broke down in momentum. Price dropped a bit, but then it's hovered for a year, either side of about 99 on the dollar index, up and down. Right now, this break we're now seeing in the dollar index is about to generate a sharp drop. So the dollar, which has been asleep for a year, really, in terms of price movement, the dollar index, which is very narrow, Japan, Euro, are the main components, 70% of the dollar index. It's about to join in and make noise as well. The kind of noise that also helps gold. So, anyway.
Wow, that's an incredible point that you just made. So the dollar index could crash significantly while gold rises, so you would have a double whammy.
Yeah, I think you could drop the dollar, which is right now around 98 or so. I think you ever get back toward 97, even the price guys are going to start to panic and realize, oh God, this wasn't a low. And I think you go all the way back down to the lows again. That means 70 or lower. That's a huge crash. I mean, I don't know if you go the crash-like way, but it'd be a huge decline. And then suddenly the dollar will become a factor. For the last 10 years, gold's gone up big. Dollar index since December 2015, we're where it was 10 years ago, 11 years ago. So dollar index has really been like this. Now suddenly it's about to do this, downside. And that will, at that point, I think, help gold. It's not a primary, but it'll tend to help.
And it sounds like it will certainly hurt U.S. equities as international investors pull their capital out.
Yep, if you're a foreigner and you've got U.S. stock market holdings, it's not just the stock market movement that upsets you if it goes down. It's what's the dollar doing when I convert it back to my euro or yen, etc. Losing money on the dollar holdings. So yeah, it could be a big factor. Nobody's talking about it right now. We are. So.
Well, you certainly left us with a lot to think about, Michael Oliver. Thank you very much for your time.
The dollar may be the missing piece that turns a gold rally into a broader currency event. Michael Oliver notes that momentum broke down in March 2025, yet the dollar index spent roughly a year moving sideways near 99 before threatening another major decline. That matters because foreign investors can lose twice, through falling US assets and currency conversion. If the dollar finally breaks its long range, precious metals could gain an unexpected tailwind.